to Geared for Growth. I'm Mike Mortlock, and in this episode, I'm joined again by Brett Warren, property strategist and long-time market analyst with a sharp eye for the fundamentals. The last time we spoke, Brisbane was still waiting for its time in the sun. Now it's one of the best performing markets alongside Perth and Adelaide. But with prices easing and past the peak, the question is, what's next? We cover that and a lot more, like whether Melbourne's affordability and fundamentals are setting it up for a comeback, what's driving the shift in buyer demand, and how smart investors can get ahead of the next cycle. Brett breaks down what to look for in today's market, from strong incomes and owner-occupier appeal to the importance of gentrification and infrastructure-led growth. We also dive into why some areas with great stories on paper may not deliver the same in capital growth. If you're wondering where the real opportunities are in a shifting landscape, this is a great conversation to help reset your thinking. Let's get into it. Brett Warren, thanks for joining me back on Geared for Growth.
Mike, been too long. Always good to catch up, and now good to be putting in some recording behind it, I guess, because we always kind of talk numbers and facts and detail. But looking forward to talking about a few different things.
I suppose you could say this every time, but it is a very different time to be speaking to you. I suppose the first time we had you on the show, Brisbane was doing nothing and had done nothing forever. And there were people sort of saying, well, Brisbane's it's got to be the next one because it's nearly half the price of Sydney. And then another 5 years of those metrics don't actually work in real life. And then it's just been absolutely bananas. One of the top three markets with Perth and Adelaide over, 23, 24, and still it's posting gains in 2025. But I wanted to ask the question, are we at the top of those three markets, and we need to sort of start having the chats about places like Melbourne? But what are your observations right now?
Great question. I certainly think we are. I think that the big thing that was always going to stop this cycle, it wasn't going to be interest rates going up. It wasn't going to be other factors. I think it's going to be affordability. And from what we're seeing now, those markets are starting to slow. If interest rates had probably stayed where they are, I think they probably would have run their course by now. But having said that, when I say run their course, they're not going to fall off the planet or anything like that. They're just going to, I guess, slow down. But these interest rate drops will continue to provide a bit more affordability probably for the next 6 to 12 months. I think probably Perth and Adelaide are at the top of the cycle. I think that affordability's played out with many other regional markets around the country. And I think, like you said, I think there's some opportunities elsewhere at the moment in other markets. And I think it is the start of almost like another cycle. As you said, Brisbane's the last decade, I guess the first 5 years were really disappointing. There was a bit of its time factor. It eventually came around and probably came around bigger and better than anyone expected, probably due to some of those COVID factors. But I think we're heading into a different period now. But having said that, I mean, you've been doing this as long as I have, Mike. The fundamentals are just so one-sided at the moment, aren't they? There's just so much demand. And, I remember 10 years ago looking out the back of my house, there was 12 or 15 cranes across Brisbane and properties being built and all that kind of thing. That's just not happening at the moment. So it's going to be an interesting period moving forward. I think it's time to probably readjust strategies and locations and things. It's probably a good time for a bit of a check.
That's interesting. I reckon maybe not the last time or perhaps the time before that you got on, we were probably talking about the Brisbane apartment oversupply problem, which is such a bizarre thing to be thinking about now when the politicians are talking about that 1.2 million homes in 5 years. We're just about to hit year 2 of that 5 years, and we're 30% behind. And that hasn't allowed for the increase in international migration as well,
right.
which is there's an argument to say, well, we need that just to keep pace with immigration, not for any of the catch up or any of our sort of domestic requirements. It's the new entrants, and that's an interesting one to unpack as well, because I remember back in the December quarter, there was a lot of pressure on the federal government to curb that, and they did in that quarter, but then it sort of seemed to get back up. When it comes to the states, do you sort of think about that in terms of where these migrants typically go and the impact that has on the markets?
Most definitely. I think that's one of our bigger things is look, 80% of people move to our bigger capital cities, Brisbane, Sydney and Melbourne. That hasn't changed. It's not going to change. Obviously a lot of people stopped moving to Melbourne over COVID, but certainly that's going to pick up. And I think over the next decade, there's probably going to be more people moving into Melbourne than there will be Sydney over that period of time. Brisbane get some of that, but I know a lot of people kind of escape up the back door as well and come up to Brisbane. And, those are the three big capitals where the demand's just going to be incredibly strong. And getting back to what you said before, I mean, because construction costs and other factors are so one-sided at the moment, I think compared to 10 years ago, apartment buildings are probably 50 to 60% behind where they were. So our immigration has ramped up, but they're just not building enough properties. And as you said before, a lot of those people that are coming over, the first port of call is generally capital cities and areas where there are apartments and things as well. If they're not there, then the next rung out is going to be absolutely belted with people wanting to move into those locations. So we are entering a period where I don't see the market going backwards anytime soon, but I think affordability will probably tap out and in certain markets. And for me, there's only really one market at the moment that still has some affordability. And as you kind of alluded to, that was Melbourne.
I was hoping you were going to leave it there, and I was going to say regional Northern Territory, which is, it's topping the yields at the moment, according to the May CoreLogic data. We're at 7.7%. Nice. Affordability is great, but I'm obviously just being silly. When it comes to affordability, I mean, we've got Brisbane median house price at 917, that's not house price, that's median price. Yeah. The houses I know have clicked over 1 million, which is crazy. Adelaide and Perth, we're into the 800s. It's really Hobart and Darwin that are the cheapies at 673 and 525. But now entering the chat as somewhat affordable is Melbourne at 791.
Amazing.
Did you ever think that would happen, or did you sort of see the writing on the wall when the land tax and the minimum standards and the residential tenancy stuff came in that people would vote with their feet?
I think that was the icing on the cake. I think that takes investors out of the market, a certain portion of investors. But the big thing that drives these kinds of markets, particularly these capital cities, are homeowners. And I think it was COVID that really held Melbourne back. So that was a bit of an X factor, a bit of a black swan event that really was isolated to Melbourne. I mean, for 18 months, they were pretty much locked down permanently. There was no one moving from the regions. In fact, a lot of the Melbourne regions have actually done okay because people have been leaving Melbourne to get out to the regions over lockdown. No people were coming in from interstate or overseas or anything like that. So for pretty much 18 months to 2 years, businesses were failing, homeowners were struggling. There's a lot of mental health issues around that as well. So I think the next wave in Melbourne will be led by those homeowners who couldn't really do much there and weren't in a great position, probably financially and mentally, to do those kinds of things. They were comfortable where they are. So I believe that's probably going to lead the next stage of the cycle. Sure, investors and stuff are going to keep away, but once, I guess similar to what happened in Perth, once the homeowners started boosting up that market and rents were quite strong, then the investors kind of came in a bit later, and I think that's probably what's going to happen in Melbourne.
Mm. Now, the Victorian economy. I know you're an expat from Perth, and yes. I saw the other day they were like, yes, we've just delivered another budget surplus. And Victoria's there sort of grovelling a little bit depressed, going, bloody West Australians with their resources and beaches and all that sort of stuff. Yeah. What is going to happen to the Victorian economy, and how important is that? Because there are some commentators sort of saying it's a basket case and it's going to put a ceiling on potential price appreciation because the investors are the ones that seemingly are being repeatedly targeted to try and get this, whether it's a COVID levy or whatever it is, but get the budget back into the black.
Great question. Really good question. Look, I think that the main thing is that, investors are being used as a bit of an ATM down there. They've got a huge budget issue and there's a big hole there from COVID. So there's obviously land taxes. Look, wouldn't surprise me if there's more taxes and more things come in to help that. So my advice is, look, we don't really know what's going to happen. There's no doubt there's some significant issues there, but as a property investor, you actually have to work out your risk management and how to actually avoid those types of situations. And in my mind, it is buying in areas where, homeowners don't worry about that. If they need to move and they need to spend an extra $50,000 to get into a school catchment or a lifestyle area, that they will do that. They're willing to do that. They're willing to look at their own budget, their own finances. Whereas investors tend to, as I guess you've pointed out, think bigger picture and land taxes and complications and government. So, if I was buying in those locations, I'd be looking for areas in the inner to middle ring suburbs of Melbourne that are dominated by homeowners, where 60, 70% of people who live in those areas, are homeowners. Most of them don't have a mortgage or are well into their mortgage. They're not as sensitive to those kinds of issues. Whereas if you're looking at, high rise off the plan, house and land packages further out that are dominated the other way around. 60-70% there are investors. They're the markets that are really going to struggle probably over the shorter term. So there's actually going to be two markets down that way. And I think, there's some significant issues for investors and investor stock and house and land and things like that as well. That's going to take a lot longer to kind of come online. Whereas even at the entry level now, there's been a couple of pockets we've identified that we've been buying in for the last 12 months. They've probably had between 5 and 10% growth in a depressed Melbourne market. Because that entry level's starting to pick up a little bit, there's a few more people that are getting to the point where I guess their rents have been climbing and skyrocketing, right? And all of a sudden, interest rates are coming down, and they're getting to the point where it's like, you know what? It's actually cheaper to almost buy a property. And I'm actually starting to see a couple of headlines down that way to say, look, in these areas, in these suburbs, it's cheaper to buy than rent. And that's when the switch starts to happen. And we're just starting to see that, where people are going, you know what? I can't keep paying these high rents. I might as well go and buy a property myself. So I think this cycle will be led from the bottom end, and that's kind of what we're seeing at ground level at the moment.
Yeah. And is it being led by the owner-occupiers or the first home buyers, or do you think that enough investors have been sort of going into Melbourne looking for the next Perth, and that's what's sort of kicked things off?
I think there's headlines about that, but I don't think that's actually happening. So I think for the last 6 months, that's been the headlines. Melbourne's back on, investors are getting right. They're moving on from Perth, they're looking for another location. But it takes time to sell, to get finance, to do those kinds of things. So we'll start to see that in the back half of the year, especially with more rate cuts. I think investors will start to come into those markets. But at the moment, it's actually home buyers, actually people wanting to sick of renting, getting to a point where they've kind of got through a period of the downturn through the COVID period, and their finances are a little bit better and they're in a bit more comfortable position. There's a bit more confidence in the outlook with interest rates coming back. So I think, and I suspect that will be the case moving forward. So I think it'll be the owner-occupiers who lead that charge over the next 6 months, and then gradually the investors will start to get in, because you're still getting quite good rental yields down that way as well.
Yep. Now, you mentioned the word affordability, and affordable properties are going to be the ones that are attracting a lot of growth and attention. Yet what you sort of described as the areas that you're looking at, middle ring, inner middle ring, established properties, presumably areas where there isn't a huge amount of exposure to investors, got a lot of people with paid off homes. I mean, that sounds like you're describing something with, if it's not blue chip, it's got a blue tinge. So yes. Are they affordable areas, or to transact in what you call investment grade stock in Victoria, do we need to forget the 500 or 600K and we need to be doing 800-900K? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Oh, look, it always helps, doesn't it? I mean, more there. But I think I would say that entry level is probably between that 550 to 750, 800 mark. I think that's that first entry home buyer level thing. And it's obviously, at the lower end, it's not going to be a house. I like the way you describe that blue tinge, because that's exactly what you want. You're not going to get into those blue chip locations unless you get an apartment. I personally would be getting that. Although I think the next 5 years are going to be very positive for apartments, as we've talked about. There's cycles with apartments and, oversupply, undersupply. But, we're getting entry-level properties like villas in complexes of 3 or 4 for, 600,000 or 700,000, 10 or 12 Ks north of the Melbourne CBD. And, if we're buying a house in Melbourne for 600,000, we're going to have to go 40 kilometres out. The land value is probably going to be, 200. It's 300, 350 to build these properties, and there's probably a bit of a premium on top of that as well. So it makes a lot of sense. And in these locations, there's two driving forces for mine, Mike. The younger generation who can't afford $1 million or $1.5 million to buy a house or an area, and they don't want to move 30, 40 Ks out. They want to stay close to the coffee shops and the restaurants and the lifestyle precinct and have good access to public transport to the city. And then at the other end, the downsizers who are, selling their family home. The kids have moved out. And they're looking to downsize as well. They're not interested in an apartment with a lift and stairs. They want something all on one level with maybe a small courtyard and something for a dog. And they're really, really highly sought after. And the good thing is as well is that they just don't build those anymore. So I think that's a really good type of property. We actually also identified an area a little bit further out. I'd probably say it's more of an outer ring suburb. down towards that Seaford, Curram Downs pocket in Melbourne for a house. We were buying houses there for probably around 700,000 about 12 months ago. It is a bit further out, but the reason we like it is because that pocket is surrounded by wetlands and parklands, and you can't build anymore. If you go north, you've got North Cranbourne and areas like that, where there's still a lot of development going on. But down in this pocket, you're landlocked. There's no more properties being built. You've got the bay there, which is huge down in Melbourne. I don't understand why, because you can only swim 2 weeks of the year down there. But they love it down there, and there's got a train line. They've got dedicated schools. We can't get into that area for, $70,000 more. So you're looking at an entry of about 770, 780 now. So in a depressed Melbourne market, these properties have actually been starting to pick up in the last 6 months, and it's been homos that have generally been driving that.
It does sort of seem like this last month, the May figures were really the first time we saw Melbourne do much. I mean, we're at 1.2% for the quarter, so there's an argument to say it's been a couple of months. But there are a lot of commentators that have sort of said, look, Melbourne's been hot for 6 months. Especially in areas that investors are pointing to, like Frankston is probably the big standout, which is funny. Like the first time I ever went to Melbourne, Frankston was sort of like the laughing stock of Melbourne. It was the working class kind of hovel. It's actually beautifully situated. I went down and watched the first Ironman Melbourne, and it started at Frankston Pier. I'm like, this place is sort of beautiful. I mean, I didn't walk around too much, but what's, I suppose, different about places like Seaford and maybe Frankston to places that I'm hearing in forums like Melton, for example, is that kind of hemmed in scarcity of land. But there are investors that are going further afield where there's maybe not those same constraints. Are people coming to you sort of saying, I wouldn't mind getting a 4-bedroom sort of project home in a newer area, and they're talking about areas like that?
Yeah, they do, and we just quickly talk them out of it because the fundamentals aren't there. And even in these areas, Frankston's kind of close to those two suburbs that I was talking about before. It's just across the motorway, the highway, but there is still that stigma. And the affordability and the wages in these areas we're looking at have shifted. They're gentrifying. So the blue tinge you alluded to, they're not a blue chip suburb, but because the older retirees and people are moving out of those areas, young families are coming in and they've got good jobs. They're knocking over houses. They're rebuilding. That's really not happening in the Frankstons and the Meltons yet as well. And then further afield, there's just too much supply. There's a lot of places being built out in those areas, and I've got no doubt they'll do okay. And as we've kind of seen, a rising tide lifts all ships. But I think it's an opportunity to get into these niche areas and actually outperform the averages and what's going to happen in those locations. Areas further out, you're relying on too much on depreciation and cash flow and things like that as well. The growth will be restricted because people don't have the ability to keep paying more for money. And in my mind, people don't get emotional about those areas. They're not going to go out there and say, I'm going to pay $50,000 too much for this property, because they just have to wait another year and there's another property up the road being built. So I guess you've got to always come back to those fundamentals and those emotional factors that owner-occupiers have.
Yeah, some great points. I reckon that there are people that invested in places like Perth, Adelaide, Brisbane in the last little while, or if they were on the sidelines, were watching pained because they were on the sidelines and not riding these big markets. It begs the question, if we're wanting to outperform, the national average, we've got Brisbane, Adelaide and Perth still ostensibly at the peak. The pace of growth is lowering, but they're still posting growth. We've got Sydney that peaked in September 24, affordability is not necessarily there, and you probably have to compromise on the asset. Melbourne's peak was March 2022. The others, we've got, Canberra, a little bit expensive for people that are looking for affordable. But then there's the two curly ones. There's Hobart, which peak of the market, according to CoreLogic, was March 2022, and Darwin, May 2014, which is bananas to think about. Are those markets that you have ever done much work in, or do you look at them, or are they lacking diversification and economic diversity that ticks your boxes?
Yeah, look, they definitely are. I think Hobart's probably got a bit of a chance there. I think that Hobart that people are becoming more on the radar and getting into those locations, and there's more, there's more demand for those kinds of pockets. Northern Territory probably not. I think those two economies aren't big enough. There's not enough pillars to the economy to ride through the good times and bring people into the country and create that level of demand. So again, I think it'll happen. But if you're an investor who's got 10 years or 15 or 20 years before you want to retire, I think there's better opportunities where you're going to get superior growth rather than kind of waiting for these other areas. And let's be honest, I think pretty much every market in Australia has shot the lights out, and you could have bought a property anywhere and done well if you've done that 5 years ago. But I think the next 5 years are going to be very, very different. And I think it's going to be coming back to those long-term fundamentals and those blue chip locations like a Sydney or a Melbourne. I think over the next 5 years, those numbers will probably start to show, and it feels like Melbourne's just starting to warm up, and Sydney's always just super consistent because it's an international city, and it's always on the radar for everybody.
Yeah. It sort of begs the question, what does the future look like in Australia? I mean, we went through the COVID period, and that kind of shook up the snow globe to some degree. We had the boom of the working from home culture. There's some people that I've spoken to that said we haven't really seen the end of that because there's offices that had 10-year leases on buildings that are going to be rolling off, almost like interest-only loans rolling off down the track, and it has a little bit of an impact. I mean, You're bullish on the three capitals. Should we be considering, well, maybe the future of work in Australia dictates that the capitals don't have the same pull that they always have, and regions need to start entering the chat?
100%. I think, look, from my point of view, that'll definitely happen. That'll continue happening. More people are going to work from home. There's no doubt that regions will become more popular. I think in those areas, though, if you think about most of the regions, there's still more growth there to happen. There's still more availability of land. There's still more projects to occur. Whereas the capitals, they don't. I guess if we're looking at, I think I did some research a while back on that, Mike, and I think it was about 35 to 40% of jobs could realistically not be done coming into the office. But that kind of still leaves 60, 65% that will need those kinds of offices and spaces and still be probably predominantly in the capital cities. So for mine, I guess my strategy, and as I said before, I think the next decade is probably going to be more like the best form of offense in the next 5 to 10 years is actually defense, and coming back to majority trends and fundamentals, because all those minority trends have worked exceptionally well in the last 5 years. But I think the next 5 years is going to be very different. So those majority trends of where people are moving, where the majority of people are living and working, I think we've got to get into those locations where there's a scarcity of land, where there's lifestyle precincts, walkability, convenience. No more properties are being built. The majority of jobs are being created in those areas, and it's not just one economic driver like a mining, or there's finance, there's services, there's other things. And I think that's where probably Hobart and Northern Territory get a little bit left behind. There's more risk in those areas. If a big project gets off put or something happens, shuts down, it affects it much more than the other areas. And similar with Perth. Perth's pretty much a big mining town, and it's done exceptionally well over the last 5 years. But the 10 years before that, it didn't do a lot. And I guess that's the next thing. I mean, a lot of these areas we've looked at that we're talking about in these outer areas and regions, we've done research over the last 20 years. And for 2010 to 2022, they've actually been pretty much flat. They've kind of had their time in the sun now because the market's gone crazy, but they're just starting to read that affordability cap, as you mentioned. It's not slowing, it's not going backwards, but the growth isn't as strong. And I just suspect we're reaching that affordability cap in those areas. And because they don't have the big fundamentals and the big drivers and the big employment hubs, the wages growth takes a lot longer, and the savings takes a lot longer in those areas to regroup and kind of go again, whereas the bigger capital cities seem to be able to recharge much quicker and get going again because they're bringing these other people in from other areas consistently.
And when you talk about these sort of middle inner bluish tinged places, you can have that one too, by the way. I'll license that to you. Are you looking at those locations as, okay, well, the asset value is X, but the incomes are actually relatively high. So from an affordability point of view, it's got legs, it's got the capacity to grow? Because I think what we sort of saw in 2024 is rents grow at such a pace that it kind of hit the ceiling of what people can actually physically go to,
Yep.
and we're seeing the behaviour change where more people are bunking up, sharing rooms, that sort of stuff. Rental growth hasn't grown in 2025 like it has in 2024.
Mm.
I think not because there's more investment properties available. There seems to be a shortage,
Yeah.
but it's a behaviour moderation because they're hitting their ceiling. So I'm just wondering if those are the areas where you kind of think, well, we've got a long way before our head starts scraping the roof.
Absolutely. And I think that's going to happen with property prices as well. There's no doubt. I mean, that's what's going to stop this property cycle for the Perths and the Adelaides and the Brisbanes. It'll be the affordability and the ability not to keep paying more. And I think interest rates are probably extending that. But for the listeners, a great website to look at is SQM Research. I think we'll probably all look at that website. But the weekly family incomes is one that we really rely a lot on, particularly over the last 20 years, if you can go back 20 years, because it'll actually show you the average for Victoria, the average for New South Wales or Queensland. And if you can plug in a postcode in a suburb, it'll actually show you the incomes compared to the average. And most of the areas we're trying to buy in, the incomes are 1.5 to 2 times better than the average. And this means people can pay more for property. In those areas, people can also pay more for rent. They've got high savings rates and buffers. So there's a lot more safety there. If there is a downturn or a crash, they can ride those kinds of periods out. They're not maxed out living paycheck to paycheck. And the other thing is as well, they've got high savings rates. So we can get through that period. And people who are paying higher rents, they're paying above average rents, especially when there's a shortage. So we want to get through to those kinds of locations because even when there is a downturn or when the cycle finishes, history will show you that they'll probably slow down for a couple of years while incomes and energies recharge. Whereas those outer areas where people are kind of paycheck to paycheck and the incomes aren't as high and as great, they probably take more like 5 to 7 years to kind of recharge before they go again.
Yeah, and I suppose if there's no buffer there, they're more likely to sell, which kind of banks the prices as at that depressed point.
Whereas, and if there is a downturn, Mike, and interest rates are up and there's a recession, I mean, it's kind of a bit of a race then and people have to sell. But in these areas, people can kind of tend to afford to hold these assets. They're also probably a little bit more established. So it's not really like a race to the bottom. It's, people don't mind. It's their home. They're 50% or 3/4 paid off their mortgage and they can kind of ride those periods out a little bit more, I guess.
I'm wondering if there are maybe 2 other aspects to it as well. I'm sure I remember chatting to you on a podcast where you kind of talked about the ratio of investors to owner-occupiers in a suburb being important because owner-occupiers are more likely to spend money on their property. Now, in these areas, there's going to be a bigger proportion of homeowners. If they've got disposable income, they've got the ability to renovate their homes, which impacts the street appeal and gentrifies the area, but also disposable income to spend at the coffee shops and the high street shops, and it builds its own little local economy that drives gentrification as well. Is that sort of part of the equation?
That's 100%. You're 100% right. And if we do a simple equation here, they're getting that percentage right. But I've renovated my home recently. I can guarantee that every owner-occupier that's rented their home in the last 5 years has paid too much and gone above and beyond what they probably wanted to. Yes, because of construction prices, but also they'll pay an extra 50 grand to put a nicer staircase in or upgrade this or upgrade that. But if you had an investor, they wouldn't do that. So, that's how you get the growth in those areas, the knockdown rebuilds, the gentrification, overcapitalising, knocking down a home, for $1 million they've purchased, spending another $1 million instead of 800, and they're the kind of things that you want to happen in those areas where they gentrify. And you've got the little ugly duckling around the corner that, is just sitting there. And a lot of the properties we bought in Brisbane when the boom first started, within a year or two, what we paid for the property was pretty much land value. And that's a key thing and something we want to happen. We want to get in those areas where the land value is quite strong. So you're 100% right. Focusing on those high income earning demographics, owner-occupiers who won't sell up and they want to keep a roof over their family's head, very, very important.
Excellent. Well, I'm learning a lot, but good. I know there'll be people listening that just kind of want the fast forward to the end. Where am I going to buy bread? Everyone that comes on this show that's in that space kind of hates the question. I mean, you've showed what the markets that you look for have in common from a macro point of view. You want areas that aren't investor heavy. You want areas that don't have the ability to produce more land. You want positive incomes. You don't want big commutes from the city or lifestyle factors. If we throw that filter on the great country of Australia, where are we going to land? Where else is there other than Melbourne for investors at the moment?
Look, Melbourne's definitely an opportunity, but look, even for people who have got 2 or 3 properties in Melbourne at the moment, it may not make sense to buy another property in Melbourne, and I guess that's the difficult thing when you're talking to people. If you're talking to someone who's based in Melbourne, you've already got 3 properties there. They're not going to tell you to go and invest somewhere else. But because of this land tax and diversification and other issues, and even for investors that aren't particularly wanting to buy in Melbourne, I do think there's some opportunities in Sydney and also in Brisbane. In Sydney, I still think the next 6 months are great because there's some first homeowner incentives coming into Sydney. And around that $700,000 or $800,000 mark, south of Sydney towards that St George area, it's kind of like a secondary beach area in Sydney. You've still got the water there. It's not really a beach, but you've still got the water. You've still got the bay there. You've got good lifestyle precincts. It's starting to gentrify. And I think that a lot of first home buyers will be drawn down that location and people who want to buy in those areas. So I think there's some good value there. I also think the yields are particularly well there. And if you don't fancy paying land tax, then that's a bit of a no-brainer. In Brisbane, definitely still think there's some upside. Every man and his dog's talking about the Olympics. I'm a little bit nervous about buying apartments and townhouses. Townhouses not so bad, but I guess apartments in Brisbane, I'm a little bit nervous there because I know it's not as mature as a Sydney or Melbourne. And by the time the Olympics roll around, there's going to be all these projects coming online, and we may get back to a bit of medium supply again. But there's nothing wrong with buying a house, around 10 or so Ks from Brisbane, with a good land content, because I think that's going to be golden moving forward, particularly once we get through the Olympics and out the other side. Once Brisbane's on the map. And I think all those people that are going to be working here and those kinds of things, it's almost deja vu because I think the last thing that sparked the Brisbane market was the fact we started creating jobs again. We weren't doing anything for a fair while there, and all of a sudden we had 200,000 jobs between the city, the second runway at the airport, the Queen's Wharf, the Cross River Rail, the Brisbane Metro. And I kind of see that happening with the Olympics as well and creating that demand for those kind of good quality properties in Brisbane as well. So, at high level, development sites are very, very highly sought after, subdividing sites. I think there's good results there because a lot of people from down south don't really like our post-war homes up here, Mike, our, knockdown rubbish properties. So they want something modern, contemporary, and they're willing to pay good money for it. And, I think in Melbourne, at the other end as well, there's probably some good opportunities for unit blocks and Art Deco apartments and things like that as well. So there's a bit of a snapshot of where we're kind of putting our clients and seeing some really good value at the moment.
I love that. I think you've given us enough to go hunting for those opportunities and some really good insights into what makes up the methodology of the way that you select assets as well. So Brett, thanks very much for coming back and sharing those insights. It'll be a very, very interesting back end of 2025. And I'm inclined to agree. I think we're not going to have, anything going gangbusters, but there's opportunities for investors out there at those lower price points. Yeah,
look, I think there always is, isn't there? I think it's just, looking at the market. And I think, as I said before, I think particularly moving forward, there's probably not going to be much leeway for good properties. I think you're going to have to get great properties if you really want to perform well. So I think getting back to the basics is important, and hopefully I've helped a few people out.
Absolutely. Thanks for coming. It's always great to chat to you, mate.
Always. Thanks, Mike.
See ya.